Today's topic is understanding basis for timber and forest land. I'm Dr. Tamara Cushing at Clemson University Extension. This timber tax educational opportunity is provided for you by the Forest Landowners Tax Council through a grant from the Forest Landowners Foundation. The Forest Landowners Tax Council is a national nonprofit organization dedicated to education of and providing a voice for family forest owners on issues of federal taxation. Today's agenda includes the following: what is basis and why should you care about it? How to determine basis at the time of initial acquisition? What changes occur to basis over time? And what to do if you don't know the basis of your assets. Let's get going. So what is basis? Basis is simply a measure of an owner's investment in a capital asset. All capital assets have a basis, whether you know what that basis is or not. It's no different whether it's timberland or whether it's your stock. So let's define capital assets so we know which assets we need to have a basis for. The Internal Revenue Code defines a capital asset as generally property held by a taxpayer. Now that word generally is fairly troublesome, but that's a word that's fairly common in the Internal Revenue Code. What the definition really means is it's only defined by exclusion. So we see references that items that are not inventory are considered a capital asset, and items that are not depreciable property are also considered a capital asset. Those are the kind of specifics that we'll see in the Internal Revenue Code when we're talking about capital assets. So why would you need to know your basis anyway? Well, at the time of any sale, your basis is going to help reduce your capital gain. So you can imagine it's very important for us to know basis when we come to the time of a sale. If we look at the basic formula for a taxable gain, we see that we're going to take the sales price, which is what you're getting paid for the asset that's being sold. We're going to subtract out the expenses related to the sale, and then we're going to subtract out our basis. So looking at this formula, if you forget to include the basis in this calculation, you're going to pay more taxes than are required by law. So there are multiple ways to determine basis, but it all comes down to how you acquired the property. For today's purposes, we're going to look at four main ways of acquiring property: through the purchase of the property, through an inheritance, property received through a gift, and property received through an exchange. Now these are just four basic categories, but they'll help us look at how basis is determined in general. So we'll start by talking about the initial purchase. The initial purchase point is the time that you want to actually break out the assets and put basis on each of the assets. It's important to think right now about this timberland as more than just the acres of ground. We've got to think about the acres as well as the timber resource that's on the acres, whether this is hardwood or softwood, whether it's immature timber or whether it's mature timber. What we're going to do is try to allocate that purchase price out between the different assets based on a percentage of fair market value. So we're going to try to allocate that purchase price between the land asset and the timber asset. We can even go further and break it into multiple different asset classes of timber based on age classes or based on certain site indices if you were interested in that, or breaking it on hardwood versus softwood. The possibilities are actually endless in that, but it's important to keep in mind how burdensome the record keeping could be the more you break that down. So I said that we're going to do this initial breakdown based on a percentage of fair market value. So let's take a minute and talk about what fair market value is. Fair market value is the price at which an asset would change hands between a willing buyer and a willing seller, neither under any compulsion to do the transaction, and both are coming to the table with reasonable knowledge. This fair market value concept is really important. It takes out transactions that occur between related parties, and it also takes out transactions where one party really doesn't know what the transaction should look like and is coming in and paying either way too much for the asset, or the seller is accepting way too little for the asset. We're going to use this fair market value simply to break that purchase price into different segments. So what we're going to do is determine the fair market value for each of the assets. For today, we're going to talk about 3 assets: land, pre-merchantable timber, that's timber that couldn't go to the market today, that if you actually had someone come in, there's a good chance you'd pay them to cut that for you. And then we'll talk about merchantable timber, the stuff you could actually expect a logger to come in and take to the gate for you. So then what we're going to do is calculate the total fair market value for the property. We're going to determine the fair market value for each asset, add that up, and that's going to be our total fair market value. Now it's important to note that the Internal Revenue Code allows you to take for your basis all the dollars that were involved in the purchase of that property. So the fair market value is really just a tool to help us break up that purchase price into the components of the property that we purchased. So let's look at an example. If we calculate the fair market value, we've got the purchase price of $100,000 for the property. The land was determined through an independent appraisal to be worth $65,000 at the time of purchase in an independent transaction. The pre-merchantable timber was determined by a forester to be worth $10,000. This is really a complicated formula that a forester would need to do for you. They're either going to project forward what that timber might look like in the future and discount the value of that back, or they're going to compound the costs forward to get to the current age. Again, go get a forester to help you get that pre-merchantable value. The merchantable timber we're going to value at $50,000. In most cases, this is simply the value is determined by looking at the total volume that's out there by product and multiplying that by the current market prices in the area. So if we add those things up, the land, the pre-merchantable timber, and the merchantable timber, we come up with a total fair market value of $125,000. Now I do want to point out that this fair market value is higher than your purchase price. I want to remind you, the Internal Revenue Code does not allow you to take the fair market value as your basis, only the purchase price. The fair market value is simply a tool to split that up into the different assets. Now it may be troubling to some people when they see that the purchase price and the fair market value have a pretty big discrepancy, mainly if the purchase price comes up higher than the total fair market value. That shouldn't be concerning to you. There are multiple reasons in forestry why we may pay more for a property than the fair market value. Some of this could be the fact that you wanted the property to be right next to yours to give you more contiguous acres. It could be that this particular property had some sentimental value to the buyer, and that's okay as well. In this case, the purchase price is lower than the fair market value. Sometimes the sum of the pieces is greater than the sum paid for the whole. Sometimes we see that the buyer knows a little bit more about the tract and is a little bit savvier than the seller, and the buyer actually got a good deal in this case. So there's multiple reasons, and it's really okay. So we're going to look at this initial allocation. Again, we're going to calculate the percentage of fair market value for each asset. So you see in the first column a description of the assets. You've got the land, the pre-merchantable timber, and the merchantable timber accounts. The next column indicates the fair market value. These were the numbers that we talked about on the previous slide. $65,000 fair market value for land, $10,000 fair market value for the pre-merchantable timber, and $50,000 fair market value for the merchantable timber. Again, we add these up and they come up to $125,000. What we want to do here is determine the percentage each asset contributes to the whole. So we'll take the $65,000 fair market value for land and divide it by the $125,000 that was the total fair market value. That gives us a percentage of 52% total fair market value for the land. We're going to repeat this process for the other two assets. $10,000 in pre-merchantable timber divided by $125,000 total fair market value showing that the pre-merchantable timber represents 8% of the total fair market value. And lastly, we'll do the merchantable timber. $50,000 divided by $125,000 gives us 40% of the total fair market value that should be allocated to the merchantable timber. Just to be careful, I would add up that final column and make sure I end up with 100%. If you don't end up with 100% and you have a math or a rounding error somewhere, you're potentially leaving some of your basis dollars on the table that won't go into an account. And certainly you want to make sure you're using all your basis dollars that you're allowed. So now we're going to take that percentage that we just calculated and apply it to the sales price. So again, starting with the land, we calculated 52% of the total fair market value was allocable to the land. So we're going to take that 52% and multiply it by the $100,000 sales price to obtain a basis in the land of $52,000. We're going to repeat this process with the other assets. 8% of the fair market value was attributable to pre-merchantable timber. We'll now multiply that by the $100,000 sales price and come up with $8,000 in the basis account for pre-merchantable timber. Next, we'll go look at merchantable timber. 40% of the total fair market value was in the merchantable timber. We'll multiply that by the $100,000 total purchase price for $40,000 that we want to allocate of the basis to merchantable timber. Add those numbers up and they again should add up to $100,000. That is the maximum that you're allowed to allocate, but you do want to make sure that you allocate every dollar of what you paid for it. There are some other methods that can be used to allocate basis at this point in time. You can use a residual approach, and basically what you're going to do is take the market value for the land, subtract it from the total you paid for the property, and whatever's left would go in the timber. This could substantially undercut the value of the timber, and since you will be cutting the timber asset before you actually sell the land, you would like to put as much as possible on the timber. So the residual approach could actually result in more value being put on the land, which is the last thing being sold. If you refer back to the equation on how this is going to reduce your taxable gain, you really want to have the first asset that you're going to sell have as much basis as you can legally defend. The method I just showed you for allocating it based on fair market value percentages is accepted by the IRS and is a method that will give you a fair amount of value on each asset that you can legally defend. The other approach you can use is you can specify in the contract at the time of acquisition how those assets are to be broken up. Even though you put a value on those assets at that time in the contract, it still should be something reasonable. A contract that spells out $1 per acre for land is not going to hold up much in the IRS's eyes. I do want to mention that we're going to talk about the other times of acquisition of an asset and what the basis is, but the process for allocating the basis between the assets is going to remain the same as what I just showed you, no matter how you got the property. If you acquire the property through an inheritance, you're still going to want to go through the process of splitting out those assets based on fair market value. So now let's talk about what the basis would be in property that's inherited. The basis in inherited property is equal to the fair market value on the date of death. This is for all assets acquired through an inheritance. The other option is if an alternate valuation date was selected, then all assets would be valued on that alternate valuation date. Some estates that are heavy in assets that change value in a short period of time may find that it's worthwhile to elect the alternate valuation date. Imagine an estate with a lot of stock in it. After the person dies, everything was valued at the date of death, but afterwards, within, let's say, a month, we see the stock prices go down in most of that portfolio. So now that a significant part of the estate has lost value, it might be worthwhile to select the alternate valuation date to revalue all the assets as of a different date. If that has been selected, then that's the basis date that you're going to use. So by taking this basis at fair market value at the date of death or the alternate valuation date, it results in what we call a stepped-up basis. So the reason it's called a stepped-up basis, if you think about a grandmother who acquired her property in 1960 and paid $100 per acre for that property. If she was to give that property to someone or to sell that property, we'll say that grandma sells the property. At the time of the sale, her basis is $100 per acre, even if she sells it in 2013. So you can imagine that that property gained a lot of value over time, and that value hasn't been captured until the point of sale. At the point of sale, there's going to be quite a bit of gain paid on that property because the basis is at $100, what was fair market value at the time that grandma acquired the property. If that same property, instead of being sold, was to go through the estate, everything is being valued at the date of death at fair market value. So let's say in 2013, when grandma dies, that the property has now got a fair market value of $2,000 an acre. If you receive that property, you're going to get the basis of $2,000 an acre. So you see that step up, if you will, from the $100 to the $2,000 an acre. And it's because that estate has gone through that estate process and is being brought back up to value. There's a provision in the Internal Revenue Code with regards to estates that they can elect to value the property for special use. This basically says that the property can be valued for its productive use in a farm, a ranch, or a forestry purpose, instead of being valued at fair market value. This election allows a reduction in the value of the property for estate tax purposes. If special use was elected, then the person who inherits the property is going to receive the value that the property went in the estate for special use. Talk to your accountant about what that value might look like. We're going to move on and talk about property received by a gift. Property received by a gift is a little bit more complicated than receiving it through an inheritance or the outright purchase of the property. Property received by a gift, the basis is going to depend on the relationship between the fair market value at the time of the gift and the adjusted basis in the hands of the person giving it to you. So let's talk about adjusted basis. Basis is not one of those things that stays static over time. We'll see adjustments to basis over the course of the ownership. These may be additions or subtractions to basis that occur over time. Those adjustments that are once made, now the basis is called adjusted basis. So that beginning equation I gave you that says you take the sales price minus the expenses minus basis really should say adjusted basis, because at the point of sale, it's the basis account as it stands at that point in time. So let's talk about some of these adjustments. We'll start by talking about additions. Any expenses that we have that would actually result in capitalizing those expenses are going to be additions to the basis account. These capitalized expenses are expenses that are going to increase the value of the property and usually have a useful life of more than 1 year. An example of some of these capitalized expenses would include roads and culverts. We also can see adjustments to the volume account. Over time, your stand continues to grow. So we see things called ingrowth, where trees will go from maybe being not measurable at the last inventory period, say they were below the minimum diameter that you were going to measure, and now when you come back later, they're at a measurable diameter. That's ingrowth. So it's a growth from the last adjustment as well as the ingrowth. Those two things are going to be additions to your basis account. Now those aren't dollar additions. Those are changes to the actual volume that's in the basis account. So in your basis account, you're going to have two pieces of information ultimately. The number of the amount of volume that's in the account, and you're also going to show the value of your investment in that asset. So the dollars that were invested as well as the volume. We also have subtractions to the basis account. This is usually the amount of basis used to offset a previous sale. So if you have a thinning that removes, say, 20% of the volume that is out on the stand, you're going to use 20% of the basis dollars to offset that sale. So what you'll have to do is go into that basis account and remove those dollars that you actually used to offset the sale. We'll also see adjustments to the volume part of the account. This is for any removals. So if I have gone in and done that thinning, I'm going to remove it from the dollar part of the basis account, but I'm also going to remove the volume that's taken out of the stand. We can also remove some of those dead trees. So back to how we're going to get the basis for this property that's received as a gift. You need to know the adjusted basis of the property. You need to know the fair market value at the time you receive the gift. And you need to know of any gift tax that was paid at the time of the transfer. So if the fair market value at the time of the sale is less than the adjusted basis, you have to look at whether the property was sold for a gain or sold for a loss. If the property is sold for a gain, we'll take the donor's basis. So if my dad was to give me the property, we're going to take my dad's basis in the property plus any adjustments that were made after I received the property. And that's going to be my basis. And then I'm going to look at that for a gain. If I sold the property for a loss, I'm going to look at the fair market value at the time that I received the gift, and then add any adjustments to basis, such as the capitalized expenses or any subtractions from previous sales. And that's the basis I'm going to use for the purpose of a loss. This is what you do if the fair market value is lower than the adjusted basis. If, however, your fair market value is greater than or equal to the adjusted basis, your basis is equal to the donor's adjusted basis plus any gift tax that's paid. What we're trying to do is account for the fact that a gift tax was paid, and that does add to the basis. Any of these basis adjustments are made that are added are post-transfer. So if you have something that happens after you receive the property, you have some basis adjustments to the property. We'll shift gears a little bit. I do want to mention on these properties that are received as a gift, gift rules don't vary depending on the asset. So if you get to your accountant and they know how to handle gifts, the fact that you have a timber asset really doesn't make anything any different. The part that might be different with regards to the gift is the actual allocation of the basis that I explained earlier in this program. So any accountant should know how to handle property received as a gift. The part they may need assistance and guidance on is how to actually separate out the land from the timber. So if we talk about property received through an exchange, there are more than one type of exchange. There's property that's received through a taxable exchange and property received through a non-taxable exchange. If the property received in the exchange is taxable, the basis of the new property is equal to the fair market value at the time of the exchange. How do you know if the exchange is taxable? Well, the exchange is taxable if cash is received at the time of the exchange, or if you receive property that's not similar. So when they're talking about exchanging, they're talking about properties predominantly that are similar in nature. So if I exchange one type of land that's growing trees for another property that's growing trees on it, those could be considered similar properties. If I receive two very different properties and they're deemed not similar, then I have a taxable exchange. If we have a non-taxable exchange, the basis in the new property is equal to the basis in the property that was exchanged. Another type of exchange really is more of an involuntary conversion, where you had property that for one reason or another was converted or taken from you. Then you go get another property. And so the new property basis can be considered the same as the old property basis. That's our starting point. We are then going to look at some additions and subtractions from that basis. The new property basis will be decreased by any loss that was recognized on the exchange. So in the involuntary conversion, if you recognized a loss on your tax return, the amount that you recognized as a loss will be subtracted from your basis. If you receive money because of the involuntary conversion and you do not use that money to purchase similar property, that cash received will be subtracted from the basis to get the new property basis. We are then going to increase our new basis by any gain that we recognize on the exchange. If you have to recognize gain on your tax return due to the exchange, so the exchange was taxable, then you're going to add that amount that you recognized to your new basis. If you have to spend any money to acquire replacement property, you're going to then add that amount to your basis. The way to think about this is if you stood to reduce your income taxes by any recognition of loss, then that's going to decrease the amount of your new basis. If you had to add anything to the investment, you had to recognize some gain or you had to pay more money in, you're going to get credit for that in the way of increasing your basis in the new property. Another circumstance we often see is like-kind exchanges. Like-kind exchanges happen in a very specific way, usually with an intermediary, somebody who is authorized to do like-kind exchanges. If you qualify for a like-kind exchange, the basis in your new property is equal to the basis in the old property. However, you're going to be able to increase this basis by any closing costs that were required to be paid or any money that was actually paid for in the exchange. Sometimes properties in a like-kind exchange are not of equal value and money has to be exchanged. If you pay any money into the like-kind exchange, it will increase your basis in the new property. So let's talk about stands that you had the property, no matter how you acquired the property, and you cut the stand or you had bare ground and you decided to put trees in the ground, or you decided to help a new stand establish by itself through natural regeneration methods. This has another basis issue. We don't have actually dollars to allocate at this point. We have the dollars that we spend to establish the new stand. So for a plantation, we're going to look at all the costs of establishing the plantation. This could be any site preparation expenses you incur. This is the seedlings, the seeds, the labor, anything that you can't deduct immediately, you're going to include in the basis of this new stand. If you have a stand that you're going to establish through natural methods, you're not going to actually put trees in the ground, but you're going to allow the ground to regenerate naturally. If you spend any money for controlling vegetation that you don't want, any money that is spent to control pests or other impediments to that stand establishing naturally, those expenditures are going to be part of the basis of this new stand. What you're going to keep in your basis account is a record of the acres. Now this is different than we talked about with that allocation before where we had a volume in that basis. Now we're going to actually only have acres. The reason for this is the stand isn't old enough to actually have any recordable volume. So as a proxy, we're going to hold on to the number of acres that are included in this stand, and we're going to hold on to those dollars that are included in the basis. At some point in the future where the stand is large enough to be considered merchantable, you will remove the acres and start keeping track of the volume in that stand. So one of the things we need to talk about is the impact of the reforestation incentive. There's another program discussing the reforestation incentive, but it's important to note that if you've taken the reforestation incentive, you have basically written off through your tax return the entire basis of the stand over the first 84 months of the stand. If you've done that, you can see that there's no dollars left to be kept in the basis account. So by the end of the 84 months, your basis account for the new stand is 0. The only way that's going to change is if you do anything that has capitalized costs involved. Those capitalized costs again would be added to your basis account. So at the time of some kind of harvesting operation, let's say a thinning or a final harvest, if you go look at that basis account, you'll no longer have those initial startup expenditures. You'll have only things that you've done in the meantime that were added to that basis account. That may concern some of you, that you are going to the point of a sale and you have nothing to offset the gain. After all, I told you it was a good thing to reduce your sales price by the expenditures and by the basis being a big component of that. It's important to remember that if I can write this basis off over the first 84 months, that now what I have is some of those tax savings to either reinvest in forestry operations on some other track, or I have the ability to go put it in another asset, in another investment. So what happens if the basis was never calculated? So some of you may be sitting there going, okay, I acquired that property through an inheritance or through a purchase 10 years ago, and I never wrote the basis down, I never broke the basis out. What should I do at this point in time? Well, we have the ability to do a retroactive basis determination. So at the time of a sale, when you recognize that you need to know the basis, it's possible to go back and calculate what your basis was. It's going to require some research. You're going to need to know what you paid for the asset at the time you acquired it. That's going to help you do that initial split. So you would need to know what the value was at the time of purchase or acquisition, what that dollar value of the basis was, and then if you need to go back out and allocate it between the assets, between the timber and the land, you're going to need a couple other pieces of information. You need to know the timber prices at the time you acquired the property. You can contact your state forestry agency or your forestry extension service in your state and see if they can help you find timber prices. You can also contact a forester, a consulting forester. You will pay somebody to help you with this process if you go with a consulting forester. The timber prices are easier to get in a lot of cases because we have documentation of those historical prices. Some foresters will have a database. There are some price services. Here in the South, where I'm located, we have Timber Mart South. In my office, I have multiple years where I can go back and look in a specific quarter for those prices. The IRS recognizes these price reporting services as a valid source of information. You'll also need to know the volume of timber that you had at the time the property was acquired, no matter how it was acquired. So if you have an inventory from the time of acquisition, that's obviously going to be the best way of having that volume. If you don't have an inventory, you may need to hire a forester to help you determine what that stand looked like at the time of purchase. The more complicated it gets, the more it's going to cost you. If you've had some harvest in the meantime, that's basis that you should have used that you didn't use that's going to have to enter into the equation, but it's also a complication in the volume part of that equation. It's not always worth the expense to pay someone to help you retroactively determine the basis and to break it into the different assets. It's hard to really know a good rule of thumb for this. We've had so many changes in timber prices. It's a function of what type of species you have and how fast growing that species is and how long ago you acquired the property. My best advice to you is to sit down, find out what it's going to cost you to do the determination, and try to get an estimate of your tax savings if you were to actually figure out the basis. Just a couple of quick endnotes for you. I want to thank the Forest Landowners Tax Council for support of this program. I'd encourage you to visit www.fltc.org and join the Forest Landowners Tax Council. I'd also like to encourage you to like the Forest Landowners Tax Council on Facebook. And then you can also visit the Forest Landowners Tax Council on Twitter at FLTC96. The Forest Landowners Tax Council provides information to forest landowners as well as those policymakers on issues that affect forest landowners. Please consider joining the Forest Landowners Tax Council. Thank you.